Good afternoon, everyone. Welcome to another session of our deep dive series. I'm Michael Durnwald, and I am the host of our deep dive series, joining you once again. Thanks for returning and tuning in. So I'll start with some of the housekeeping notes. We love questions. This is sort of your opportunity to ask questions, and we welcome them. And so to do that, you're going to look at the upper right-hand corner of your screen, and there's a question panel, and that's how you can submit your questions. And also note that we will send a copy of today's recorded session as well as the presentation slides. And it takes up to 2 business days for our gurus to process that. So after that, you'll get it. So as we've mentioned in the past through this series, Secure 2.0, when it was passed, predominantly targeted defined contribution plans like 401k plans. And our webinars so far have reflected that and focusing on provisions that apply to those plans. However, Secure 2.0 did not totally ignore the pension plans, and there are a few specific pension plan provisions, as well as some provisions that sort of warrant revisiting as they apply in the pension plan context. So that's sort of the purpose of today's webinar, is to give pension plans some love. And since they have been neglected, I am giving them extra love by not only bringing one big gun pension plan expert, but 2. So let's take a look. So on our left, we have Katie Kohn, who is a partner in our Washington, D.C. office, and a focus of her legal career has been pension plans, and that includes a stint at the PBGC. So maybe if you ask the right question, you could get some insider information out of her. That's a joke, she won't do that. And then in the middle, we have a senior counsel joining me here in our Cleveland office, Brian Gage, and he has years of experience working with pension plans, sort of in all aspects. And then there's me on the right. I look the same as I have in the previous webinars. So with that, I'm going to hand it over to Brian to get us started with some required RMD love. But here's sort of the agenda for today. Those are sort of the main topics we're going to be covering. And now it is over to Brian.
Yes, thank you, Michael. And I just thank you everybody for attending today. Actually, I'm delighted to see so many participants because, you know, pension plans have been around for a long time. And my story I always like when I go to parties with my wife, her uncle, who's in his 80s now, always says, oh, yeah, those younger people just don't realize what they gave up when they were giving up their pensions. And he's always grateful for having a pension benefit. And you know, a lot of the focus these days on our work is de-risking activities. And so there's a couple of aspects of today's presentation that'll touch on that. But it's important for compliance reasons. Other parts of the Secure Act, you know, do apply to the pension plans, the defined benefit pension plans. So the first part we're going to talk about is the required minimum distributions. And the first part of this is that the age has increased. So you probably have heard it's going to be, or is 73 for an individual who attains age 72 after December 31, 2022, and they have to be age 73 before January 1, 2033. And then the second new cutoff was it's going to be age 75 if you're an individual who attains age 74 after December 31, 2032. The drafters didn't realize that someone born in 1959 actually satisfies both of those rules. And so the Congress, according to a letter that, you know, 4 top key people in Congress sent to the IRS, is that they will eventually come out with a technical correction saying that it's age 73 for those born in 1959. That may be years away before a technical correction bill finally makes its way through, but that's what it will apply. So implementation on this provision, it's effective now, although you can do plan amendments all the way through December 31, 2025. But in applying your plan provisions, you'll need to think about it now. One place where it's probably good to update it is the summary plan description, because there usually is some mention as far as when you're required to begin your distributions. We also have code section 402F special tax notices. Usually your third-party providers provide that to your participants. And sometimes they update them and sometimes they wait. It probably depends on the provider. It's good to ask them if they're going to make their own special adjustments to the model IRS notice, or if they're actually going to wait until the IRS comes out with their model notice. It's usually, one would hope, again, some of the guidance has been fairly, I would say, slow coming out of the IRS. I think they have a lot on their plate at the moment. And so, when they're going to come out with a new model to reflect some of the changes in Secure Act 2.0 is unknown at the moment. Now, one of the things when we're thinking about required minimum distributions is that there's two aspects to this. One is the plan document. What it provides is basically, I call the plan's earlier forced commencement date as compared to the IRS minimum required distribution. So some plans, actually, I do know of one plan, and it's really this first bullet point is, they actually force people to commence their benefit at 70.5. And the good thing with that is that they don't have to do the actual adjustment for periods after age 70.5. Even if you continue to work, you still have to give an actuarial adjustment. The rule where you say, oh, we have a suspension of benefits notice only works through your normal retirement date to the age 70.5. So for those, it's actually, they don't even allow people to postpone commencements after they terminate employment. They actually just commence at 70.5. Others, after you terminate employment on the last round for Secure Act 1.0, they had a decision to make. Should they keep what I call their plan forced commencement date at 70.5 and just build into their plan the IRS minimum required distribution rules to commence at the new age 72 at that time? And the answer for a lot of our clients was yes, they rather not have people delay commencement. And there's a couple good reasons for that. One is that often you get lost participants. You also have cognition issues sometimes as people get more and more elderly. At times things get confusing, and kind of the combination of being either lost participant or the diminished capacity issues. They said, no, let's just get people to commence. So if you're going to have an earlier forced commencement date, it's really critical to have it in your document distinguishing between those two pieces, and so that you would, or at least in my mind, have this is what the plan says you have to commence, and then have the provisions for when the IRS requires commencement. And one of the reasons for that is early distribution, eligible rollover provisions. Eligible rollover provisions say if you're subject to minimum required distributions under the code, you have to reduce the amount of the lump sum distribution that's being eligible for rollover. But say your plan has a 70.5 piece where you're saying, oh, we're going to require people to take a lump sum at 70.5 or to commence their distribution, they would be able to roll over that entire amount. So it's just a little bit cleaner. As far as the defined benefit plans, that's actually all that happened on the required minimum distribution side. The defined contribution side had, as Michael likes to say, a lot more love in the Secure Act. They had all the provisions about the 10-year rule for beneficiaries and designated beneficiaries when they commence and different things. Those provisions are not part of the defined benefit plan world. So you actually have to learn two sets of rules, one for your defined benefit plans and that other kind of new set of rules for your defined contribution plans, those add-on provisions beyond these provisions where you commence. The second thing that in the mandatory part was mandatory cash outs, increasing the limit from 5,000 to 7,000. And two aspects of this is I think everybody likes the idea. It's consistent with all the de-risking everyone likes to do as far as more people we get out of the plan, especially small benefits. It saves us on PBGC premiums. And so the first part of this is to check your documents. does it say 5,000 or does it say where, automatically adjust on its own? Most plans I think use the 5,000, so you'll have to go in there and change the documents. And this is coming up. It's effective for distributions after December 31, 2023. Two parts to that you need to think about is when you're going to implement this, presuming if you desire to, is, how are you going to implement it? Is it just for future people who terminate employment, you're going to do it? Are you going to do a special sweep to go back and look at prior accounts? So there's a little bit of analysis that our plan sponsors and plan administrators need to think about as far as, do you maybe just do for new hires initially and then do a sweep later on? But you'll want to coordinate that with your plan document language.
And Brian, we do have a question that came in on this, how you talked about checking the plan document to see if it says 5,000 or just sort of keys it to whatever the tax code says. And the questioner is asking, obviously it makes sense to key it to the tax code provision so then you don't have to worry about an amendment, but they want to know, is there any downside to doing that you can think of?
Well, I think yeah, I mean, in one sense, yes, it saves you the ability to do the amendment. I think the other side of it maybe as a downside is this whole issue about the sweep and then what group is and then the timing of it. Because even though most plan sponsors want to do it immediately, especially for the terminated employees, there is a little bit of thought process of maybe we don't want to do it for, immediately to do a sweep on it. And so you might have to do some other types of provisions. And then, the other component of it is that you always, if you have an automatic provision in the plan, you need to remember that it's in there. And so that you're thinking that you actually know it's going to 7,000 and that you really want that at that point in time. So it's always good to be, it's nice because you save a little bit of an amendment, but on the other hand, you still need to be thoughtful of knowing what's in your plan, and you're still going to have to update your SPDs or your communication election packages. So I think it's probably a small piece of the cost of the implementation.
Yeah, no, and that makes sense because I know some of our clients struggle even with, if it says 5,000 under the current rules, staying on top of that and making sure that those are actually cashed out. So then we are now moving on to plan notices and reporting.
Thanks. And I was laughing during the introduction, Michael, because you said that I worked at the PBGC and I might give inside information, which was a joke, but that's actually that's I think half the reason why some people are friends with me. So if there's any inside information requests, then let me know. So I am here to talk about notices and reporting. And starting with paper statements, the Secure 2.0, over the years, there's been a movement away from paper to more electronic, and you've seen this in some of the DOL safe harbor regulations and the IRS electronic disclosure regulation. But Secure 2.0 went back a little bit toward paper in that certain notices, and particularly with the DB plans, the pension benefit statements that are required to be provided every 3 years must be provided on paper, at least for folks that initially become eligible to participate or who first become beneficiaries eligible for benefits after December 31st, 2025. So they are required to receive a paper notice. There is also a requirement that the notice provide additional information about how to get the notices electronically, as well as get additional notices, not just the pension benefit statement, but other types of notices on paper for no fee. So the sponsor isn't permitted to charge a fee for paper delivery. This doesn't apply, this requirement to provide paper statement doesn't apply to current participants who are currently receiving electronic delivery under the department's current safe harbor regulations. So those folks can still be provided electronic pension benefit statements. Secure 2.0 requires that the DOL amend its existing electronic delivery regulations, so the 2002 and 2020 e-delivery safe harbor regulations. And the DOL asked questions about this requirement in the August 7th, I believe, RFI that it put out with grab bag kind of questions relating to the Secure 2.0 implementation. And one of these questions, several of these questions had to deal with paper statements. The department asked, for instance, whether in amending these regulations, there should be an access in fact requirement for electronic statements. So currently, the regulations require that there be appropriate measures taken so that it's reasonably calculated to ensure actual delivery through electronic means, or actual receipt rather. And the department is asking whether there are requirements that they can put into place to ensure actual receipt, whether there are ways that sponsors can track that. And so we'll see what the comments are or the responses to that RFI are, and then what the department actually ends up putting out. These requirements are effective for plan years beginning after 12/31/25, so we have a couple more years still, but it's something to keep in mind. Also note that Secure 2.0 doesn't modify the IRS e-disclosure regulation, which is a bit more flexible than the DOLs, and essentially requires only that the recipient of the notice have the effective ability to access electronic documents. So just wanted to note that.
Okay, we had a question come in on this provision as well. And so the individual is asking, would this requirement apply to participants with a benefit due who are actively employed, or only apply to the sort of actively employed individuals, or would it also extend to those who are terminated? And their understanding is that it would only apply to active employees.
Oh, so it applies to anybody that is required to receive a pension benefit statement.
And so that would include sort of the vested terms.
Yeah.
Okay, great.
Okay. All right. Sorry, I'm looking at the, okay. So annual funding notices, there are a number of changes made by Secure 2.0. Probably one of the most prominent will be that the funding target attainment percentage in the funding section of the annual funding notice is no longer required to be provided or reported, and instead what's required is the percentage of plan liabilities funded, which is essentially a year-end measurement using market value of assets rather than actuarial value, disregarding the pre-funding balances, if any, and using a year-end liability measurement using unadjusted spot segment rates. So that is that's the only measure in the funding section that's required to be reported for the reporting year and the 2 prior years. There's also some addition, and also on that, I'll say that the requirement is still there to provide an explanation of the funding target, that using adjusted rates could cause the participants, or sorry, the plan sponsor to put in less money than is kind of needed to fund the plan. And so in the RFI that the DOL put out last month, they did ask whether the people think it will be confusing for participants to still see references to the to the funding target attainment percentage. So we will see if the department has anything to say on that. But right now, that's what the statute requires, and the funding information is to be provided in tabular form. There's some additional information that's required. So a pension, there must be a statement that in the event of a termination, PBGC's calculation of liabilities is different, so it could result in greater liabilities. That the average return on assets for the plan year needs to be reported. Participant demographic information for the 2 prior plan years in addition to the reporting year. The actual funded percentages of the plan if the plan is not at least 100% funded. And then a statement regarding the sufficiency of the assets to pay vested but non-guaranteed benefits, so benefits that are above the PBGC guarantee limit, and that the participant could receive more in benefits, even notwithstanding the PBGC guarantee, if the assets are sufficient to cover those benefits. And this is all beginning for plan years beginning after the end of this year. Hopefully, we will get a model from the Department of Labor on this new AFN.
Okay, and then Katie, we have another question. This goes towards the top bullet about the change in how sort of the funding is determined. And this, I think, starts to venture into actuary land, so I don't know if you answer it, but the questioner wants to know if sort of this change in methodology would generally result in better sort of funding percentages for plan sponsors.
Better, I think probably, yeah, that's a good question. And now I'm getting nervous that off the top I'm going to say the wrong thing. I don't think that it would be better, but I guess we just have to see how the math works out on that. But I think as a general matter, the funding, especially, I mean, it depends on the interest rate environment, right? But right now, I think the FTAP will show a better funded percentage than the spot rates will.
Great. So now let's move to lump sum windows.
Okay. And if I got that wrong, sorry. Okay, so lump sum windows, as Brian said, we're focusing a lot right now on de-risking, and so lump sum windows are a tool that a lot of sponsors are using to take liabilities off of the plan, or out of the plan and sort of off the sponsor's balance sheet. And starting potentially next year, although the effective date really depends on when we get regulations from the Department of Labor, which can't be earlier than December 29th of this year. And then the regulations will state when the effective date of those regulations are. But sponsors need to provide notices to participants and to the PBGC and DOL 90 days, 30 days prior, and then 90 days after, as you can see on this slide. So,
sorry to interrupt, but could we sort of back up a second? And I'm not sure everyone knows kind of what this lump sum window concept is. Could you briefly explain that?
Sure, yeah, sure. Good question. So a lump sum window is a limited opportunity essentially for participants, terminated vested participants primarily, but retirees can also participate. It's not as common in a limited ability to elect a lump sum of their benefit rather than just wait to take an annuity. So these are typically going to be in plans where there is no lump sum, or the lump sum threshold is, there's some threshold. It's not just an unlimited ability to take a lump sum. And participants have maybe 30 days, 60 days, whatever it is that the sponsor designs. I mean, post Secure 2.0, it's going to be more mandated, but a limited period of time to elect a lump sum. And that sponsors will use this tool to typically take advantage of a more favorable interest rate environment where lump sums are cheaper than in a lower interest rate environment. And that's why sponsors are electing this option now. And it's something that sponsors need to weigh, because as you take money out of the plan to pay for these lump sums, even though you might be quote unquote getting a good deal on the pricing of the lump sum because of the interest rate environment, you're taking money out of the plan that can then not be used to grow in terms of asset growth and close a funding gap, which is something that sponsors need to weigh, do a cost benefit analysis. So is that, you think that's a good explanation, Michael?
Yes, thanks.
Okay, great, right. So currently sponsors might give participants 30 days, 45 days. It's typically, in my experience at least, it's typically not longer than 45 days for a participant to elect a lump sum. And under Secure 2.0, that notice period or election period, or there is a notice period 90 days prior to even the election window opening. So where you have to provide participants with a lot of information, like the options available, how the relative values of the lump sum versus other optional forms of benefits available to them. They have to be offered a qualified annuity along with the lump sum, and potentially other options depending on how the window is structured. They need to be provided an explanation of how the lump sum is calculated, potential risks, general tax rules, and also general instructions. So the ERISA Advisory Committee came out with a kind of a form, participant disclosure, which in the August RFI, the department attached to the RFI as an example of a participant disclosure that we can use to, I guess, start with as a basis for providing information to or response to the RFI to the department. But it does contain the example from the ERISA Advisory Committee does contain a lot of the information that, in my experience at least, is provided to participants already. So I don't think that in terms of the content of the notices to participants, it's going to be much different than what is already going to participants. It's more this 90-day period, notice period prior to the lump sum window opening is something that is not currently done, typically at least. And so that's going to be something that sponsors need to be aware of and make sure that they do. And then in addition to the participant notices, there's pre-window notices that a notice that must be provided to the PBGC and the Department of Labor. And this will include the total number of eligible participants and beneficiaries for the window. So participants and beneficiaries eligible to participate in the window, the length of the window, and then the explanation of how the lump sum was calculated, a lot of the information that is provided in the notices to the participants, and then a sample of the notice. And then a post-window report to those agencies, and that this is 90 days after the window closes, with basically the number of participants and beneficiaries that participated in the window by electing a lump sum, and then any other information that the agencies request. So the Department of Labor in the RFI asked if there was additional information that should be requested. And I note that both of these notices, both the pre-window notice and the post-window report to the agencies are publicly available. So it's, it's just going to be on a website for public consumption essentially. And so sponsors should be aware of that.
Yeah, and we had a couple questions on this. So following up on this publicly available information, will this public information basically act as data mining for plaintiff's counsel? Like if a plan sponsor does a lump sum window, should they be bracing for, potential litigation from participants?
Yeah, I think that that's a concern anytime you have a database essentially of information on what a sponsor has done with respect to its benefit plans, and benefit plans, both DB and DC, have been targeted by the plaintiffs' firms for these class actions. For lump sums, I mean, it's a set law decision, right? This isn't a fiduciary decision to actually do a lump sum window. The implementation of a lump sum window is a fiduciary action. So potentially plaintiffs' firms could pick up, or participants could pick up on some fiduciary, implementation of these windows. Although I'll say that it doesn't, at least from what is just the requirements that are just in the statute, not having seen any regulations on these notices, it doesn't seem like there's a ton of information. So I think it's just more of a concern of we're now going to know what companies are doing these lump sums, and that is potentially going to provide a roadmap, or at least a place for plaintiffs to go to ask more questions.
Okay, and then we have another suspicious listener, and they want to know, did Congress provide any explanation of why it wants this information provided to the PBGC and the DOL, or what sort of the PBGC and DOL will do with the information, i.e., if we offer a lump sum window, should we expect the government to come knocking?
Yeah, no, I mean, it's a good question. And since I'm not in Congress, I don't know exactly what was going on in the minds of the lawmakers, but I'll say that the PBGC and the DOL have long been suspicious, or they don't really like de-risking actions, and especially the PBGC's mission is to continue these defined benefit plans and to create and to protect retirement security for the participants. And lump sum windows are certainly seen by the regulators as risky for participants who don't know how to manage their own money, whereas receiving an annuity is guaranteed income for the remainder of the participant's life, and potentially the remainder of the beneficiary's life. So I think it's more just information gathering for the agencies so that they can understand what is, how these lump sum windows are being used or elected by participants to assess the impact on retirement security in the country.
Great, so that's it for the lump sum window questions. So I'll move on to the next slide here.
Yep, and then just a general reporting and disclosure review. The Act directs the Department of Labor in consultation with PBGC and Treasury to review the existing reporting and disclosure requirements for the agencies with respect to retirement plans, and to assess the effectiveness of these requirements and potentially recommend ways to consolidate and simplify the reporting and disclosure. So that's something that the Department of Labor at least has said they're moving forward on with a separate request for information at a later date. So it wasn't included in the August RFI, but that's certainly a project that they need to take on. It's required by the Act, but that report doesn't need to be issued until, it needs to be issued by the end of 2025. So they have some time on that.
All right, this is Brian returning to talk about recovery of overpayments. One note to start off with is that there was an entire presentation on EPCRS, on the employee plans process to make corrections and how the Secure Act affected that a few weeks back. And so you could go and look at that for sort of the whole, schematic of the Secure Act changes. But what we wanted to focus on was just basically some experience on the pension side. And in a lot of ways, the provisions have a flavor of being aimed at the pension plans because they talk about non-decreasing annuities as, one form of guidance that's provided in the Secure Act 2.0. And that really is primarily a defined benefit pension plan matter as compared to the defined contribution plans. So with that, we'll turn to the first one, next slide on the overpayments. And there's some good parts about this Secure 2.0 on this is that a fiduciary may forgo collection of inadvertent overpayments from participants, plan sponsor in most situations, or any plan fiduciary unless breached fiduciary duties, and plan sponsor generally is not required to make the plan whole. Overall, this has been welcome, especially the part about plan fiduciaries or foregoing collection from plan sponsors. It always was strange to clients when we went out and said, well, the safe harbor provision under the IRS guidance is that if you decide not to collect from the participant, the plan sponsor should be making the plan whole. And they say, but that doesn't make sense. We make minimum required contributions each year. We don't want to go and make any special payments to the plan. And the answer to that was, well, you would be out of the safe harbor. You'd still be within the EPCRS because it says the safe harbor correction methods that the IRS sets forth in their guidance are not the only reasonable collection or correction methods. And so a lot of times plan sponsors were not making, or plan fiduciaries in conjunction, were actually not putting in the extra money in the defined benefit pension plans to make them whole. And the kind of welcome relief that now that's been sanctioned by Congress as, kind of what a lot of sponsors were doing on their own is now basically becomes a safe harbor because it's in the statute. The second part of this is that it deals with not collecting from participants. Sometimes it was very clear that the plan sponsor said, no, we don't want to collect from the participant. It was our mistake. It's a small amount. It's been for 25 years. This participant's been receiving this extra $50 a month. We're not going to do anything about it. And then you still got in the position where the prior EPCRS guidance said, oh, you still need to send them out a notice saying, oh, we made an error, and oh, by the way, we need to collect from you, and you phrase the letters in a way that the participants will hopefully not repay you. Actually, some have, some in those situations actually, we're very good at saying, oh, well, here, I'll repay. But for the most part, there was no intent. I mean, there was an intent. You wanted to send out the letter, but if the participant didn't want to repay, it wasn't likely in that situation that the sponsor or fiduciaries would have been comfortable trying to do any kind of collection mechanism because of estoppel concerns. I've had this for 25 years, and there wasn't a feeling that you actually would take further steps to try to collect besides sending the letter out. But the good news now, and again, it's a welcome relief, is that if you forgo this collection, you don't have to go out and tell participants or that, hey, we want to collect from you, and this is not eligible for rollover. And actually, the good news is for participant side of it, it is eligible for rollover. If it's inadvertent and you get a lump sum out to a participant, they roll it over into their IRA or maybe a 401k plan that accepts rollovers, they're permitted to have that tax relief. They don't have to then take it immediately into income. It's it's their benefit for actually now getting more than they would have been required. And again, there was a lot of complications for a long time because of the provision in the old guidance and in the Internal Revenue Code about how did you treat those situations, is that if we sent it out and said it wasn't eligible for rollover, well, what does that do to the participant? Do they have to file amended tax returns? Do they have to, there's a technical analysis that would say you have to do certain things, but in the most part, again, it was one of those where people really didn't follow the technical. They said, as a practical matter, just pay us back the money, or if the participant decided on their own how they wanted to file their taxes, I think most of them probably didn't do anything with it. And so the good news is again, these areas where there was a lot of, I would say, rub, where it just did not work well in practice, the Congress stepped in and basically gave us 2 very welcome reliefs to do that. And so go ahead.
So yeah, I have a question from a listener here. They want to know if you could provide an example or 2 of sort of a real life example of what an inadvertent overpayment is. And then I just sort of like tack on to that. Is inadvertent overpayment sort of a legally defined term in the statute, or is it just sort of the plain sort of English meaning?
It is not, it isn't defined, so it doesn't say inadvertent means this. I think, in at least how I've read it, and I don't, again, we don't have guidance on it. I think that the standard errors that people typically make in a defined benefit plan, you messed up the compensation, so they got too much in calculating their final average paid benefit, or that basically, things I said the other day, somebody elected a joint and survivor annuity, but for some reason they were paying the single life annuity out. Or, and so they were getting this extra amount, or it turned out that, now at the time we're terminating the plan or doing an annuity lift out or all of that, all of a sudden we go through and everybody's doing the deep dive on the data and find out, oh, the person really wasn't age 66, they were age 65 or 69, and it adjusts the annuity a little bit. And so I think all of that, to me, is clearly within the meaning of inadvertent. I don't think it has any greater. I think what it's really aimed at is that some of these provisions, like for these overpayments, could create huge gaps or holes of ways. For instance, somebody comes in and says, oh, I'm in a 401k plan. I want to get money out. So you paid the person the money out and said, oh, I made a mistake. It was an overpayment. Well, no, that wasn't inadvertent if you knew what was going on. I think that is going to be where the IRS and the line really is intended, is that, we're not talking about some kind of structure where the sponsor is trying to do something more than is intended. I think is the other one. I see we have
Brian, I mean, I'll jump in too, because I think what's required under Secure 2.0, even though, yes, we don't have guidance yet, is there has to be processes in place to avoid overpayments, and those processes need to be followed. So and that just underscores the importance of having processes in place and following them, so that you kind of get the benefit of the doubt in these scenarios.
Yeah, I mean, that's yes, I agree with that. And again, I just had a situation recently. The same thing is that there was kind of a gap in their processes where some things were happening or distributions were happening when they really weren't, or something happens. And really, as part of the process, that even though you don't have to go out and collect the overpayments, certainly if you have a process that's not working, part of the whole goal of EPCRS is that you have to make steps to correct the process, so you don't have errors in the future. So I agree with Katie, is that if you have some kind of systematic issue where something's not working and you don't correct it, query whether that would be inadvertent any longer. It seemed like there's kind of an intentionality, but I think for the most part, pension plans, you have your record keepers are so involved in doing and TPAs and in administering these plans and having processes, is I think again, I think most things would be covered. And I think actually I see another question, which is actually a slide that we're going to talk about in a couple. So we'll postpone on the next question.
We have a psychic listener.
Yes, very good. It's a hot issue, and that's what we're trying to focus on. There's these new restrictions on recoupment for the non-decreasing. Again, the prior situation where somebody was paid too much, like $100 for 20 years. And then you all would come in and decides, okay, well, we're going to shut off your, we always wrestle with these. Well, how much should we take from the person's benefit? We say, oh, we're going to collect it all up front. So you get, oh, I'm sorry, poor, participant, you on your 80th birthday, we're going to shut off your pension for 10 years until we recoup everything. Or, do we let it, or are we going to take out half of it? Or, are we going to demand it all immediately? You have to sell your house to repay it. But the relief is that they put restrictions on it, and basically you can only take little pieces of it. The statute doesn't say what about recoupment from other payments. Those are always much more difficult because, and again, distinguishing like even in a pension plan, if the person takes a lump sum, it's, are you going to go out and really get the collection agency and try to chase down? The dynamics were different. And what's kind of funny is that the people who took the annuity actually were at a disadvantage in these situations from people who took the lump sum, because the lump sum had this overlay of litigation costs that may prevent you from going out to recoup. Whereas if they were still receiving monies from the plan, you almost were required by, in one respect, to saying, oh, well, then we have the money, we can just offset that. That's not going to cost us anything. Why shouldn't we do it? And the reason why you didn't want to is because of either estoppel or just the situation of the person not wanting to change their benefits. And here's just some of the protections. Again, these actually apply, and we're talking non-decreasing annuities, but this really, some of these apply to both. You're basically, if it's over 3 years out, you can't collect it. Mixed feelings there. Sometimes, again, my examples is you didn't want to, but sometimes it's borderline if you think they really were getting too much, or sort of like, oh, they maybe they should have known, or who knows. We're going to get in this. If they knew that the benefit payment or amounts were materially in excess of the correct amount, that's an exception to this. If they're culpable, you can actually, some of the protections like this 3-year rule doesn't apply. But you may have a different situation where, there's a significant amount of money and they were a significantly highly paid compensated employee that you said, oh, hey, maybe we should go out and collect because we want to keep the funded status of the plan. And so, but now we have a general rule is that sometimes there's a little mixed feelings. Sometimes people like to have gone out or basically almost like a bargaining chip and saying, oh, well, we're not going to recoup the past, but we're going to correct the forward. Be very grateful for what we're, that we kind of split it in half, where you don't have that leverage anymore. So like, oh, we can't recoup from you from the past. And okay, by the way, here we are going forward. This one about overpayments to participant may not be collected from participants' beneficiary. That's been around for a while, at least for the IRS on spouses, that they said, if you overpaid a participant, you can't collect it from the spouse's QGSA rights or qualified pre-retirement survivor annuity rights. Claims process, and then threat of litigation, etc. But the next slide goes to the question that was asked by, well, payments made after a participant's death to a participant's account and before a plan notified or discovered the death. And these have two parts. One is the post-death cash checks, and the other one are the direct deposits. And really what I've seen where people are is on this one is that they don't like this, and they basically are continuing to collect in these scenarios. Even if the person's been in pay status for 20 years, or the participant was in pay status for 20 years, dies, and then all of a sudden there's 6 months of payments out there that somebody's been signing the checks and cashing them, they're still going after it. And there's really three possible ways you can try to get there. One is culpable. Well, everybody knows you don't sign somebody else's check. Come on, that's actually fraud. You could be in criminal trouble on some of those. And so certainly, there's no guidance yet, but it certainly sounds like you should know better than that. the other part of it, it's kind of nuances, is that, when they talk about inadvertent, we say, what's inadvertent? Well, in some ways, it's not a mistake being done by the plan, which is usually when you think of mistakes. The mistake almost is that somebody is taking the money. And is it inadvertent in at least in one way, is another possible way to go at it. And the other way, at least the way I'd also think about it, it's not a payment to a participant or a beneficiary. It's somebody else. It's somebody who's not entitled to the money. And so, I mean, if you accidentally, somebody was defrauding your plan and for 50 years never was a participant, but somehow went in and through cyber theft or something is getting payments from your plan, certainly they can't contest, well, you can't collect from me, it's been over 3 years. It's no, you probably have the exception for culpable, but there's also a notion that maybe you're not a participant or beneficiary. And so that's really what I sense, is that basically there's some concern about it. And again, the checking cash checks is a little bit easier because somebody is physically doing something wrong. The direct deposit one is a little bit less clear because, it's going into the account, nobody's touching it. But again, I think there's room enough to say that, that isn't kind of, it feels different actually than having overpaid to the participant. And it certainly seems like there's a culpability thing. Whoever's getting that money should know better that actually somebody dies, you should know to go and check what kind of direct deposits are going into their account. And I always love whenever new situations come up, I always put in my checklist to ask into, ways that we can, you can get less than you expected, is to add it to the SPD. And in the future, I'm thinking about adding a new one of my little bullets that says, please be aware that we might collect from, please advise your heirs or people who survive you that they're not supposed to cash checks and they're supposed to stop the direct deposits. Hopefully that answered the participant's question. I see we have another one.
Yeah, and I think that one we'll have to tackle offline. I think there's some clarification needed there. And then also in consideration of the remaining time.
Oh, yes.
We have a little hodgepodge of miscellaneous pension plan provisions that Katie's gonna walk us through. So let's get those teed up.
Great. Okay, so I'll talk about a couple, especially the cash balance backloading rules are a little bit nerdy. So if there's, so for those of you who like math, this is for you, and especially those of you who are familiar with or need to administer cash balance plans. So Secure 2.0 gave relief to, excuse me, to sponsors of cash balance plans that have variable interest crediting rates. So these would be plans that tie the interest crediting rate to, for instance, the plan performance, asset performance. And these plans have been difficult to administer because from a design perspective, because they've often violated the code's anti-backloading rules, which are designed to prevent plans from concentrating benefit accruals at the end of participants' careers. So for variable interest crediting rates, the IRS rules had previously required that plans use the most recent or the current interest crediting rate to project interest credits for future years when doing the backloading test. So for years in which the crediting rate is 0 or negative, it would be difficult for plans to pass the anti-backloading or the backloading test. But in Secure 2.0, now plans are permitted to assume just a reasonable projection of actual interest crediting rate, but it can't exceed 6%. So this is going to make it much easier for these plans to pass the backloading test and also to provide higher interest credits to an older population. Actually just state that, yeah, and then the updated mortality tables just very quickly. So the Treasury Department needs to cap is required under Secure 2.0 to cap the mortality improvements for the mortality tables for minimum funding purposes, and they can't be greater than 0.78%. The increases can't be greater than 0.78% for plan years starting on January 1st of next year. Okay. All right, retirement savings lost and found. This is something that we just got a question on the other day. This is a database that the DOL in consultation with Treasury is required to create, and it'll be a searchable it's intended to be a searchable database where participants and beneficiaries can go and input their name and the name of the company that they worked for to try to find their missing benefits. And what I think the idea is for the database to be able to spit out contact information for the participant or beneficiary to then go to the plan sponsor to make a claim for benefits. So starting next year, plans need to start providing the department with information, with certain information to help populate this database. That'll be the name of the plan, the name and address of the plan administrator, and then also provide notice of any changes to the name of the plan or the name and address of the plan administrator, if there's been a termination or merger, basically anything that any changes that impact the plan or the ability of a participant or beneficiary to find their benefit will need to be provided. And then the name of the participants or former participants who terminated, who received a mandatory cash out or a deferred annuity contract will all need to be provided to the Department of Labor for this database. And the database will be available by the end of next year, by December 29th of next year. There's the department is aware and takes seriously the duty to ensure that participants' information is protected. So that's something that is on their mind and that they're aware of. And also, there also needs to be ability for participants to opt out of this database and to remove their information from it. Okay. And just a few other things. The discretionary amendments to increase benefits are permitted up until the taxpayer's deadline to file the tax return, so it doesn't need to be end of plan year. Variable rate indexing for PBGC, the PBGC variable rate premiums are now frozen. They're not going to be indexed, so it's going to be capped at $52 per $1,000 of unfunded vested benefits, but that doesn't, I mean, the premiums can still increase because the per participant cap is going to continue to be indexed. So the cost can still increase for these variable rate premiums, but not as significantly, and which is arguably a good thing or arguably appropriate given that the PBGC surplus as of the end of last fiscal year was over $37 billion. 95-1, so the 95-1 is the revenue bulletin that the Department of Labor put out in 1995 that requires fiduciaries to evaluate the insurer's ability to pay claims and the creditworthiness of insurers in an annuity purchase. So that might be a lift out or even a termination anytime plans are sending liabilities to an insurer, the fiduciary needs to undergo this, what we call a 95-1 analysis. The interpretive bulletin is what I was thinking of. And currently there's a number of factors that a fiduciary needs to take into account, such as the quality of the insurer's investment portfolio, the size of the annuity purchase relative to the insurer, things like that. I mean, I know we're running out of time, so I'll breeze through this, but that needs to be reviewed by the Department of Labor. I know on the ERISA Advisory Council, there are a number of members that don't believe any further changes are needed. And then quickly on retiree health benefits, the ability to transfer assets from an overfunded DB plan to a retiree health account to pay retiree health or life benefits has been extended to the end of 2032. And there's also a new de minimis transfer provision in Secure 2.0 that allows de minimis assets that don't exceed 1.75% of the plan assets to be transferred if the plan is funded at least 110% over the previous 2 years. So that's a change from the prior law.
Okay, and then I'm going to wrap it up with a few administrative notes. If you still have any questions, please reach out to your normal sort of benefits contact at Thompson Hine, and they can, quarterback to the right person. If you don't know or have a contact, you can contact any of the three of us, which the information is there at the end of the slides, and we'll do our best to answer your questions. The next webinar is October 25th. It'll be addressing a fairly new concept about portability and roll-ins. So if you want to learn more about what that is and what it entails, please tune in. You'll get an invite maybe this week or early next week. And the invite to that webinar will also include the recording and the slides from this one. So with that, sorry for keeping you 2 minutes over, and we appreciate you attending, and we look forward to seeing you next time. Have a good day.